11 now, but we have a great panel of bankers and an owner to discuss where we are in terms of finance and the prospects ahead. And our moderator is Mr. Dimitris Sofianopoulos, who's partner and head of the Greek office of Norton. Dimitris.
Thanksgiving. Hi, everybody. I will agree with Kevin. It's a fantastic panel. Which, of course, it will be more difficult for me to control all these great banking guys and Iannis Lazarizis. Introducing them not in any order, but in the order as they are sitting. We have Michael Visser, who is an associate director at NIBC and operates out of Singapore with over 20 years of experience in ship finance. We then have next to him Faak, who is the global head of shipping for Nordea. Oliver, again, has over 20 years of experience, has been to a number of, I have to say, German banks like DVB Bank or HSH or Dresdner before that. Next to him will be our only ship owners representative for today, Mr. Iannis Lazarizis, who happens to be both the CEO and the CFO of Capital Product Partners LP, which are listed in the US, as most of us know. Next to Yanni is Thor, Erling, Kylstad, who heads Nordea in London, shipping finance. And again, someone you will know, Dagfinn Lunde, who is head of the shipping division for DVB, but also a member of the board of the managing directors. And last but not least, Arcadis, who heads the representative office of Amro in Greece. So we'll start with, as Kevin already said, 2012 is already done. We're pretty much in 2013, particularly as ship finance budgets are being depleted, whatever has been left of them. But I will start with Dagfinn Lunde, who is the most senior banker, I have to say, on this panel, to ask him how he sees what has been the state of ship finance in 2012 in his own experience.
Thank you very much for the introduction. Very difficult task to try to define. Was there a market at all? That's the first question. I got an overview of the ship financing market, and when we talk about the ship financing, you start very often by saying, how are the commercial banks doing and what are they doing? Ship financing for 2012, as for 11, became a game of ECAs, export credit agencies. They are now copying the aviation industry by basically relying more and more on ECAs. You can see that everywhere. The capacity from the commercial banks, I will come back to that in another question, why the capacity is much lower. But the capacity from the commercial banks has definitely been reduced. What has happened then is, of course, the export credits are coming in all over the place. You have the banks financing the yards, supporting the delivery of the ships. And then, of course, you have a lot of more equity going into each project. The new thing on top of that is, of course, that we see that the private equity is slowly, they are looking at a lot, and they are coming in. I made an overview, we are probably coming back to it a bit, but I made an overview in our own bank, and in the last 3 years, we have leveraged 40 equity, private equity companies into shipping. And our portfolio at the moment is about $2 billion in leveraged PE firms into shipping. So that is coming. And there is much more money coming into shipping. And and especially if we can prove, as we talked about earlier today, that we have hit the bottom and there is an upside. I think Natasha was indicating it, that they were looking for the bottom point and the upside potential. But looking forward, I have gone through the list of all the banks. We have done a survey internally because we have normally used a lot for other banks for syndication and supporting us on bilateral deals and so on, and also to watch the competitors. So I have a list of about 50 banks active, who were active, and instead of reading all the names for you and telling everybody's strategy, I summarized it in the potential for ship financing with commercial banks on 4 words. You need to be a core client and a well-known client of the bank, then you have a chance. You need to have a corporate structure which is solid and proven. If you can put energy or offshore to the project, you are really safe, because there is much more capacity from the banks. Same banks as reducing shipping at the moment, they are still expanding in energy. And if there's smells of offshore, I think even the shuttle tanker can come under offshore nomination, and then you will get the money. And the last word I will use in looking for potential for financing will be employment. That you have a cash flow in the project, and that the project cash flow for the next 4 or 5 years is okay, then you have a good chance as well. So those are the 4 key words: being a core client, being a corporate structure, being close to energy or offshore, and having some. If you're not in those areas, you at least have to have an employment and being close to the cargo. Those are the 4 words I would say. Then you still have a chance. So 13 might not be so bad if you want that.
Thank you, Dagfinn. Taking in view of what you said, I would like to ask for Erling, what would a banker, here Dagfinn saying something about that, what would a banker like to see in order to get in today's market a credit deal through the credit committee?
Yeah, thank you. As always, the assessment of the credit risk is kind of a starting point, and that has not changed, and will not change going forward either. And I think also in general you see that banks have become more strict and on the actual requirements in the transaction, and also banks are more conservative at this time than we have seen in previous years. That conservative on terms in terms of leverage, repayment, employment, financial position of the borrower, etc. So I think maybe the key point going forward is maybe not necessarily the credit issue, because we believe that if you have a transaction you do today which is conservative, you are at low in the market cycle, and if that transaction is made in a way so it survives today, it will definitely also survive tomorrow. So I think the key with the banks is that it's more the allocation of balance sheet capacity, and a little bit of what Dagfinn also was into. In order to get attention and get that capital allocated, there is a very strong client focus within the banks. It's not enough that the deal is good. It has to be that the client also is important to the bank. And then of course, if you have a good long-term relationship with the bank, that's important. Whether it's a target client of the bank, and also the financial and operational qualities of the company is very important. And then there's a lot of attention on return requirements, so that the deal has to, or the relationship has to be able to meet the requirements of the banks in that sense. And of course, obviously, it has to be within the credit policy of the bank, and there has to be potential for additional business. That has become very important in the last few years, being derivatives or deposits, etc. So I think that those are kind of some of the important issues the way I see it.
Okay, I think you've added a number of things. Dagfinn's 4 main
start writing it down, this goes straight against their base capital and could kill almost all of the banks right away. But if you look at Basel III in itself, you know that that's supposed to come into effect in 2019, and we all thought we had a lot of time for it. But when you get new rules like that, everybody starts looking at your neighbor or the auditors, everybody starts looking at you and saying, will you make it? And why don't you do it right away? So a lot of banks will now try to achieve this already at the end of this year, including most of us here, I guess. And what that really means, just to give you an idea, if you take the balance sheet of European banks in general at the end of 10, which is the last number I had for this purpose, they will need over over $1 trillion in Tier 1 capital. And that is an incredible number to satisfy all these capital requirements. And you know that there are 3 elements of the Basel III which will have an influence. The first influence is that all those things banks had in their balance sheet or outside the balance sheet which could influence the balance sheet, they are now getting onto the asset side. So you add up a lot of things into the asset side. That's the first effect of Basel III. So the balance sheet will be blown up by all those previous balance sheet things which turned out in the crisis to become on the balance sheet for many banks. The second element of Basel III is that all the Tier 2 and 3 capital, which were not what I call real capital, which is some kind of hybrid form accepted in the previous regime, they will all be ignored in the capital or calculation for the future. Meaning that for some banks, especially the Landesbank in Germany, some of them will lose between 40 and 50% of what they used as having as capital into the new system. So that means that not only are you blowing up your asset side, but you also completely erode your equity, what was called equity. And I think that this is the correct way of thinking, because of course these hybrid capital forms were not really capital in terms of solidity of the banks, but they were used as part of it. So that is the second element. The third element is also very interesting on Basel III, and that is that they will increase the need for banks to have liquidity reserves. And can you imagine if you ask the regulators in any country, what should I put my money into to be showing you an appropriate liquidity reserve? Can you guess what it is? Yes, sovereign bonds. So they will now encourage us to hold sovereign bonds as liquidity reserve. So all those 3 elements. And again, if you do that, of course you blow up your balance sheet extra by keeping those extra bonds. So those are the 3 elements which make all those banks in Europe specifically very sensitive to, and they will need a lot of capital. And I don't see with the earnings or lack of earnings in banking, I think only the governments can in many countries support capital. So it will be very tough. It is tough. On the US sector, it's a bit easier because they had, we expected it to be a bit lower capital requirements in the US market, but it's marginally less. We talk 1.3 billion is estimated in Europe. It's about 800 billion in the US market. So, but still, there will be an enormous amount of capital required to fulfill these new requirements. So we don't know where the banks will make it, and that is why banks will do both things. They will both raise capital and get dilution of the present shareholders, but at the same time they have to reduce their balance sheets. So that is what's going on. They work on both sides of the balance sheet.
Thank you, Dagfinn. Michael, the Visser, you are in Singapore, so I know there are things that are seen in a different way sometimes, but is the era of easy money over? Is this true for everybody? There is no easy money anymore? Because I heard also Oliver next to you saying that
where we focus on in every transaction, there are three elements in my view. That's the asset, that's the employment, and that's the ship company itself. And if you look in the old days, we could do transactions on the basis of asset with employment, rather than on recourse type of transactions. These days, the focus is much more on the basis of ship owners with diversified fleet, vessels with high leverage, vessels with low leverage, older and young vessels, and employment and more employment, which gives them a stable cash flow going forward. And that's what we need to bring to so not so much the focus on employment, but much more the focus on is the company able to operate throughout the crisis.
Well, it's a question I have in mind. I don't know how many of you would like to answer it, but I would ask George. Thanks to me, he's Greek. Greek shipping, being Greek and being in the middle of all this turmoil about the Eurozone, the Greek exit or the non-Greek exit, is that a factor also when you do business or not really?
Well, not really for maybe, and I think for most of the banks, European and non-European, banks appreciate that shipping enjoys a very special status, as I understand is also the case in other countries in Europe. It's an offshore business, not directly related to the development of the Greek economy. In that respect, all the situation in Greece has not really affected the appetite of the banks to do business with Greek shipping companies. At the same time, Asian banks and ECA organizations, they tend to ask more questions about the Greek crisis for the simple reason that they are not very familiar with what is happening in Europe, as well as with the nature of shipping in Europe. If I can make some very short remarks about the Greek economy, obviously there has been a lot of discussion in the last 2 years about whether Greece will stay or exit the Eurozone. It's very good that for the last 3 months at least, there is political stability in Greece. There is indeed very high unemployment, squeezed liquidity, there is a deep recession. But there is more optimism now than before. And we all believe that things will get better. It's a fact that we've managed within a period of less than 3 years to cut our deficit to about 1/3 of what it was in 2009. And that's a big achievement. And very few people in Europe speak about the good things that have happened in Greece. And we tend to focus only on the bad things. So I strongly believe that things will get better. There are a lot of things that we still need to do, a lot of reforms in order to make the markets more efficient and more competitive. I'm sure that all this will happen. And as Mrs. Merkel said here in Athens last week, she sees light at the end of the tunnel.
Okay, it was an interesting response. I would like, clearly, you have your own views, so I would like to just ask very quickly Thor, Erling, who deals with a number of Greek shipping companies, if the issue of Greek shipping, Greek flag, has bothered him, or he has, the second thought with all these things going on, or not really.
Well, I mean, I don't think we haven't changed our principal approach to the Greek market. Of course, we are following development closely, and obviously there are other entities in the bank that are not involved in our daily shipping business that are asking us questions. So we have to kind of provide information to other places in the bank. But as I said, in principle, our approach to the market has not changed. But as a more general comment, I still feel that there are a number of banks that have become more cautious towards the Greek market.
May I
see private equity? Is it welcome? Is it working for the shipping industry, you think? And how does it work for you? What is your view on this?
Thank you, Dimitri. And I think for private equity, we have to look back a number of years. And certainly today, there are many more names compared to the past, and bigger names compared to the past, that are willing to get involved in shipping. Certainly they see that we are at a low point in the cycle, and certainly today the shipping industry, value-wise, is on most segments on relative lows. And therefore, many private equity fund managers have been and discussed projects with many owners, including us. The main issue is their exit strategy and how they look into their returns. Because at the end of the day, you make most money in shipping when numbers don't add up. And certain owners are more familiar with that and more willing to take that risk compared to PE managers that are answerable to bigger credit committees, and they have defined exit strategies, and they have defined return requirements vis-a-vis the owners of their funds. So certainly equity today for owners is scarce and it is expensive. Therefore PE is welcome, but it's not necessarily the cheapest money. I think that as long as private equity and ship owners work together and agree on an exit strategy, as well as the PE fund managers are willing to look and accept the cyclicality of shipping along the fact that they may be required to inject working capital throughout the project, then potentially that is a platform for both parties to discuss. Also, owners should appreciate the much more strict corporate culture of a PE fund, especially of the bigger ones, when it comes to making decisions. So, if you look back of the investments of private equity into shipping, at least the higher profile ones, not necessarily all of them have worked to date. And there are a number of names that have put money, and I'm not sure if they're willing to stay or they're actually looking for an exit. So PE is welcome, to go back to your original question. Certainly it is putting more money compared to the past, but I'm not so sure whether this is going to be enough to compensate for the lower amount of money that is coming from the banks.
Okay. I would ask Oliver, probably the reverse question is, particularly in light of the fact that he's looking at restructurings, etc. Is he happy to see private equity houses working with their clients, with his clients, and doing business together, and him being the lender of such ship owners or such vehicles?
Well, yes, definitely private equity firms are welcomed by ourselves, and I think also by my colleagues, by the other days. And it was interesting enough for us to experience that private equity firms are not only interested or focusing on investments on a corporate level, but especially on a single vessel fleet of vessels case. So investing in steel, because when I look back at former conferences, it was always mentioned that the main focus on private equity firms is minority share in corporates. So what we have experienced already are investments in steel in the end. What we see, what we have seen are two main categories, situations where the private equity mainly was acquired by the shipowner itself, bringing them in, presenting them to the bank in order to get equity out of vessels or fleet of vessels who are in the money, so to say, getting out this equity here for these vessels, for this fleet, in order to have this equity, this liquidity free for supporting other activities within this profit. Second category So nothing is for free. What then could be required is to compensate, so to say, the pain for the private equity firm to invest in such a distressed asset, whilst additionally giving a commitment to finance projects more or less eco-friendly designs of here later as well. So these are the two main categories, and yes, private equity firms are welcome to.
I don't want to overrate this issue, but I would like to ask George, since they have a private equity arm within Fortis, I mean, the same applies to Dagfinn, I guess, within Amro, same applies to Dagfinn, and having this dual role, is always an issue, but how do they see private equity within their organizations? Taking the hat of a Lunde, or I guess sometimes the hat of an equity component?
Yeah, I mean, first of all, these are two different business lines. So the people who are involved on the lending side are not involved on the equity side, because this creates a conflict. But my view of private equity firms, we call them internally financial investors, is positive. I think shipping is not a game for traditional ship owners only. US private equity firms, they have identified certain opportunities in shipping, and provided that they join forces with the right shipping companies, and they are patient, there's no doubt that they will make money. I think their presence increases the liquidity in the system, makes the sale and purchase market more active. I can only see positive factors, and we have done business actually with, lending business with a few financial investors who decided to join, to make partnerships with clients of the bank here in Greece. I don't know whether this trend will continue. It might continue in 2013. There is a lot of money in the US. So maybe, there is more capital coming from that source.
Yeah, I know you're trying to pull my leg on this one, but let me start, like George is saying. Of course, I indicated by so much activity. We have already leveraged, as I say, 40 companies, and that means if we have leveraged 2 billion into joint ventures or fully owned issues by PE firms, that means that they have invested at least 4 billion in those structures. So it's quite a lot of money. We of course very welcome these things, and it's very nice to see their strategy, and I agree very much with Oliver. They are thinking much more asset-based, and you can see that in the general society of investment, the PE firms, that they are more and more looking for assets and not papers only. So that is a very nice trend, I think, in general. When it comes to our funds, we have different kinds of funds. We have our own 100% owned funds. We have joint venture funds. And we have funds where also private equity companies are owning 80% of our funds. We do 20%. The principle we have is that we never do a fund management without our own money in, so they know that we have our money at stake. And I would say that again, in those joint ventures, they do look for assets always. They want to have the complete control of the asset, and they want to link it up to a good operator. And don't forget, many of these are very strategic. We should not forget these are very, very professional people. You feel it the very moment they start looking at the project. Their due diligence is enormous. Everything is on the table. Their spreadsheets are very professional. Their yield requirements and the way they look at how to get the yield is very, very well thought out. Their strategies are very clear, and they just follow through. They just do what they say, and of course the market might make a turn they didn't expect. But most of the cases you can see that they have so much money behind, and they do strategic thinking, and when it's 1 or 2 years off, they still go through it. And I professional board. Normally they want to be in control normally. And it is for the bank at least fantastic to see. So we have this.
Okay, two quick questions, and I think we're coming close to our 45 minutes, but I do need to ask Iannis Lazarizis. We talked about private equity, commercial banks. What about high yield bonds? We haven't seen that many owners, and I have to combine that with Thor, Erling and the Norwegian bond market. Okay, so, but we haven't seen that many bonds from definitely Greek ship owners, but mainly from, generally speaking, ship owners around the world, save for the Norwegian bond markets, which I really want to ask for my own benefit for Erling afterwards, whether it works for everyone or not really. But Iannis, if you mind.
Sure. The high yield market in the US, it's at a record level. The average yield of a high yield issue is approximately 6.5%. That's a record level. And there have been $150 billion worth of high yield bonds issued this year. It's again a record. And that's a number 20% above 2010, which was another record year. However, shipping does not feature in that. As if you look at shipping issues, the average yield is well north of 10%. There is about 6 or 7 names that have bonds which are longer than 5 years that yield less than 10%. So what the shipping market lacks is visibility, and unfortunately many names in the shipping business have failed, and unfortunately the reputation has not been great. And there are some names currently which are facing problems, and the yields have rocketed. So if you want to take advantage of the high yield market, certainly you need to have charter coverage at good rates, looking ahead, and to convince the market that the rates at which you have fixed up are not vulnerable. You need to have a good equity base, and if you pay dividend, you have to be able to square the circle and pay dividends as well as the high coupon. So I think that the high yield market for shipping, at least in the US, will not be, let's say, a source of money for quite a bit longer as things currently stand.
Okay, so just a few words about the Norwegian bond market. I mean, there has been a very strong volume in that market so far in 2012, and I think the volume seen as of the end of September is higher than it has been for every year for the last 5 years. So the bond market, the Norwegian bond market is definitely open, but it's not open for everyone. Just to give you a little bit more background on what's being done in the market, I mean, it can cover both rated and unrated companies, and it covers a wide range of sectors, including maritime, offshore, and shipping. Within shipping, I think mostly what we have seen being done in the market is related to the chemical operators, LNG, and car carriers. The bonds are typically non-secured and non-amortizing, and tenor, again, typically 5 years or less, but there's some development towards longer maturities. But I mean, the clue, and that's why this is probably not going to save the international ship finance market, is that the Norwegian link, the way we see it at least, is important. Or in the broader sense, the Nordic link, and you might have seen that Lazarizis in Denmark just did a transaction. But I think name recognition is important for the participants in this market, and we think the market is likely to remain an important source of funding for its core markets, but we believe it's less likely to become an important source of financing of non-Norwegian and non-Nordic shipping projects or offshore projects.
Thank you.
Do we have any questions from the floor on ship finance in 2013? I mean, my take from the whole thing was fairly positive, I must say. I mean, it looks as if for the right deal and for the right client and with some employment in the corporate structure, there seems to be finance available, so it's not all doom and gloom by any means. No questions? Okay, Dimitris and panel, thank you very much.